Hello and welcome back to another great session, loan processing under mortgage production. So soon after the rate lock, the loan goes for the complete processing. So during processing, various kinds of statements are required and many other reports are generated. There are specialized agencies. Okay, so in one particular, which basically specialized in a particular activity. Collectively, all these may be called as settlement providers. So the loan processing basically consists of verification of the borrower information, property related information collection and the validation, credit scoring, title search, and regulatory tasks. So the borrower is required to support his financial credentials as disclosed by him earlier with the supporting documents in hard or a soft copy format. He needs to provide the statements in standard acceptable formats, and that basically validates a couple of things. So first one is income. Lenders generally say that housing expenses should not exceed 25% to 28% of the homeowner's gross monthly income, which is also called as debt to income ratio, DTI ratio. The housing expenses include monthly mortgage principal, interest payments, property taxes, and the homeowner's insurance. For example, Federal Housing Administration FHA loans, this figure is not to exceed 29% of the homeowner's gross monthly income. Apart from steady employment, income also includes overtime bonus and commissions, and net income and the self-employment, social security, veterans benefits and the retirement. If you have any alimony, child support and income from the public assistance program, workman's compensation or permanent disability payments, interest and divided income, rental income after deducting the expenses and the debt payments, income from the trust, partnerships, professional corporations. What is debt? So lenders also take into consideration borrowers' regular monthly debts and the obligations. Other real estate loans, installment loans like bank loans, auto loans, tuition loans, etc., revolving accounts, alimony, and the child support. Housing expenses plus long-term debt should not be more than 33% to 36% of gross monthly income. So for the Federal Housing Administration FHA loans, this figure should not exceed 41% because FHA loans are guaranteed by the government. So FHA loans with this figure should not cross 41% of the home buyer's gross monthly income. Lenders usually define the long-term debt as the monthly expenses extending more than 10 months into the future. Having the idea of what monthly mortgage payments the borrower can afford will help in determining the maximum loan amount that can be borrowed. So the monthly mortgage payment that is affordable will help in deciding the right kind of the mortgage for the borrower. For example, a 15-year fixed rate mortgage requires higher monthly payments than the 30-year loan. And the third thing is down payment. So lenders expect borrowers to have enough money available to make the down payment, usually up to 20% of ask price for the house, and to pay the closing costs, 3% to 6% of the loan amount. The following sources may be considered for a down payment savings, like stocks and bonds, mutual funds, employee saving plans, individual retirement accounts, etc. Some mortgage programs allow the use of a gift money from the parents or relatives that need not to be repaid, or grants from a non-profit housing assistance organization for a part of down payment. If borrower does not have enough money for the down payment that most lenders require, then they may obtain a high LTV, which is greater than 80% of the loan, and for accessing this loan, the borrowers might be required to take out private mortgage insurance, which is also called as PMI. So basically, it allows a mortgage loan with a down payment as low as 5%. An FHA, like Federal Housing Administration and Veteran Administration, or RHS, Rural Housing Scheme program, may also be considered for this kind of down payments. So down payments on the FHA loan can be as low as 3%, and closing costs can be wrapped into the mortgage. But FHA loans cannot exceed the statutory limit. RHS and VA loans usually require no down payment, but they are only available for eligible applicants. It's not like everybody can apply for the RHS and VA loans. In recent years, Fannie Mae and Freddie Mac have also introduced low down payment programs, like community home buyers program, like Fannie Mae, which is basically just 3% of the down payment, and Fannie Neighbors. If a household income is no more than area's median income, the borrower is eligible for these loan types. Home steps. Special financing. Only a 5% down payment and no mortgage insurance is required. Local government may support other home buying programs in a specific area. So the pledged asset mortgage allows a prospective home buyer who has a sufficient income to meet monthly payments toward a home, but who cannot save the necessary down payment to borrow up to 100% of the sales price when a family member pledges a stable financial asset equal to 30% of the loan amount. All right, so next thing is the employment and the financials. So in the employment financials, basically borrower needs to provide a verification of employment, that is often called as VOE, to validate his employment details. It may also be verified by the verbal confirmation. This is called verbal employee verification of the employment. Verbal VOE is accepted in case of low LTV and a high credit rating of the borrower. And the borrower needs to submit the document supporting his financial status in accordance with the level of disclosure he wants to make. The loan price and the loan types usually get determined based on the proofs of the documentation provided by the borrower related to his assets, income, and the employment. Disclosure levels are chosen out of the following, not exhaustive, like if it is a full and alternative, so employment and income should be fully verified, and asset also should be fully verified. And stated income, like income stated which is not verified, and verbal verification of the employment is also required, but assets again fully verified. So there are different type of employment and financial verification happens. One is full doc loans. With this kind of loan, all income and assets are documented. Income is documented using the pay stubs and W-2s for the salaried borrowers. The self-employed borrowers use the federal tax returns to verify the income. The loan application checklist covers most supporting documents that the borrower and any co-borrower will need to apply. Once the borrower has applied, the lender provides him with a detailed list of documentation required to approve the loan. It requires the borrower to provide the complete employment, income, and asset information and supporting documentation for each one of them. So the information provided by the borrower must cover a defined period and must be verified by the lender. Okay, what is stated income? So income is stated but not verified. So employment is verbally verified with no reference to income. Assets are fully verified. The income stated by the borrower must be deemed reasonable by the underwriter for the borrower's type of employment and the line of work. Additionally, the borrower's stated income must be supported by the amount of verified assets shown on the application. No income, no assets, which is called as NINA. Neither income nor assets are stated or verified. Employment is stated, or verbal verification of the employment is required. Other information what the lender might look for. The borrower information which needs to be collected includes his full name, social security number, home phone, date of birth, and years of school. Marital status, which is married, unmarried, and separated, whichever belongs to the borrower. Present address. Additionally, the borrower must indicate whether the property is owned or rented and how long he or she has lived there. Property-related information. The lender orders various kinds of reports to get independent assessment done for the property. The services of various settlement providers used for generating the following report. First one is the appraisal. So property appraisal. An appraisal is an estimate value of the property made by a qualified professional called an appraiser. An appraisal of a property is a critical factor in determining how much a mortgage the lender will approve as the property serves as collateral for the loan. The appraiser generally is chosen by the mortgage lender, or the borrower can locate a qualified appraiser by contacting one of the professional organizations such as the Appraisal Institute of the American Society of Appraisers, provided the appraiser is in the approved list of the vendor. So what is flood appraisal? In 1968, Congress has created the National Flood Insurance Program, which is also called as NFIP, in response to the rising cost of the taxpayer-funded disaster relief for the flood victims and the increasing amount of the damage caused by the floods. So the Mitigation Division, a component of the Federal Emergency Management Agency, which is also called as FEMA, manages the NFIP and oversees the floodplain management and mapping components of the program. So what is credit scoring? So credit scoring is an important part of is an important part of the loan processing. Lenders generally outsource this function to agencies that are specialized in these activities. These agencies have record of all the major transactions done or failed to be done in a case of the payment dues, like again delinquents, by the borrower in the recent history. The lenders generally seek the credit reports from more than one vendor and typically calculate an average credit score that will be used for underwriting purposes. So the credit rating is the key data that decides what type of loan, like ABC or Alt-A or subprime loan, etc., the borrower is eligible to take. Credit scoring systems provided by basically credit scoring systems is provided by reporting agencies like Equifax, and who analyze and combine the 5 key factors to obtain a single credit score. The most important factor, of course, is a borrower's record of paying their debts. Primary emphasis is placed on the last 2 years of the payment history on currently outstanding debts. So a large number of inquiries can basically credit scoring system also look at number of inquiries to borrowers' credit reports over the last 6 to 12 months. A large number of inquiries can indicate that the borrower has been making an effort to obtain too much new credit too quickly. So this is about credit scoring. Okay, and let's learn about the title search. So title search is basically the borrower needs to make sure that the property they are going to buy is not under the litigation or any dispute, and the seller holds a clear title to the same which can be transferred in his name. If the property title is not clear, then this is a big risk to the lender. Thus, lenders order title search reports to make sure that the title of the property is without any litigation and also free from any other lien against it. What is the regulatory task? There are like few tasks which are required to be done by the lender before funding of the loan. So these are legally binding activities to be done by the lender. Customer Identification Program, which is also called as CIP. So the US Patriot Act mandates that financial institutions like lenders to have an effective customer identification program in place to collect identifying information about the customers opening an account. Verify that the customers are who they say they are. Thus, all the lenders ask for the multiple forms of the identification proofs pertinent to the borrower. Next one is OFAC check. The US government maintains a list of individuals who are blacklisted. The financial institutions like lenders are restricted from entering into any transaction with them. Thus, it is mandatory that the lenders verify that the borrower does not belong to that particular group, which is called as OFAC check. Pipeline risk management. So lenders have various kinds of loans at the various stages in the production process. These loans are with varying maturities, rate lock periods, borrower credentials, and other characteristics. This is called as a loan pipeline. A loan becomes a part of the pipeline as soon as it is rate locked, and it is supposed to be in pipeline till it is closed and funded. A lender has to mitigate, basically he has to hedge the risk of the interest rate changing since the loan was rate locked. As it cannot pass on the market rate at closing to the borrower, the rate lock is a contract with the borrower to offer the rate that is locked. So the lenders have to keep a close watch on the pipeline and hedge against the possible interest rate fluctuations for the loans that they believe will be closed. So based on the past trends. That's all about the loan processing module. So I hope you enjoyed this session. So I would see you in the next topic. Thank you.